I think it's important to note like mitigating capital gains and depreciation recapture. Now, where is this coming from? When you purchase a property, whether it's a rental or your primary residence, and you ideally buy it for, let's just say, 500,000 and you sell it for 1 million, there's going to be capital gains of at most $500,000 right there, minus any improvements you had or any real estate commissions or expenses prior to the end of the sale. So with this capital gain, you're going to be adding this to your taxable income, or what we call AGI, or adjusted gross income. You can check out some of the other videos that we have surrounding this topic. But I think for starters, for people learning about taxes, understanding your AGI, where it's at, you need to know what this is and don't look around confused and what is AGI. In a nutshell, if you don't know what it is, go and take your annual income and maybe subtract 20, 30 grand off of it. That's a good starting point because basically what it is, how much money you make, whether it's through W-2, 1099s, or your passive income, add that all together and you get to subtract some deductions here or there. But that's a good starting point. Most of our investors these days, their AGIs are anywhere from like 150 to $500,000 a year. Typically higher income earners is what this category is. So let's break this down first with your primary residence. Since the cool thing about primary residence is you're able to have an exemption on $500,000 of capital gains, which if you want to get really technical, it's like 250,000 on both of you and your spouse. So both of you guys get 500,000. If you're single, you're only getting half of this, which is $500,000. But let's just assume most people are married here and you're going to get that full $500,000 exemption there. Now, this is where you have to get on the same page with your CPA. And most of our clients, 95% of them have to change their CPAs because they don't really understand the differences between these passive losses they get from real estate coming from bonus depreciation, using that to offset their passive income, which in this case is what we're calling the capital gain from your long-term holdings, such as your primary residence or your rental properties. Now, what's going to be going on here is you basically, let's just say, going back to the example of you have a $500,000 capital gain. You bought a house for about 500,000 and now you're selling it for $1 million. And your AGI is going to take that hit. So maybe you made $200,000 is normally your AGI. It's going to bump up from 200 to 700,000, that plus $500,000 of AGI right there. But because it was your primary residence, and there's a lot of rules surrounding what your primary residence is, what you're able to do is use the owner's exemption and knock off that $500,000 capital gain, keeping your AGI at $200,000. Of course, this is a real clean, simple example. Some of you guys might be selling off properties and only having $100,000, $200,000 capital gain, or some of you guys might be selling off properties with a $700 million plus capital gain. Now, certain examples might line up to different strategies, such as the 1031 exchange, which to me makes sense when your capital gain is over a couple $1 million. And at this point, we'd probably say if you haven't joined our investor group, join, you get a free complimentary onboarding call. We can talk to your personal situation. I'm just a guy talking to the camera right here, and we're just going to roll with this $500,000 capital gain example. Now, the cool thing about passive real estate investing, such as in syndications or even rental properties, although rental properties, you don't have as good tax benefits with that. You can use the passive losses you get from these deals and offset capital events such as a home sale or rental property sale, because it's all under the category of passive activity. Now, again, this is where some CPAs might argue with it. But what I argue is the CPA is still working his day job. Are they following the techniques that the wealthy people are doing? If not, maybe you need to leave them and find somebody that we use within our network. What's important to note that, again, these passive losses that you're getting through the depreciation of the asset in a syndication deal or your rental properties, those can be used to offset these passive activity gains, such as selling off your rental or your home, but it can't be used to offset your ordinary income, such as your W-2, your 1099s, or anything you're getting from like your day job or your active stock portfolio trading. And a lot of you guys make a lot of money, which some of your guys' salaries are amazing, in my opinion, anywhere from $200 to $1 million a year. And that's just what it's going to be. You're going to have to make a lot and pay a lot in taxes. I call this the high friction, but there's a technique here, which a lot of the investors will do, which is, Again, you can't use passive losses to offset ordinary income, but unless you're able to implement real estate professional status on your taxes. Now, what this is a designation on your taxes, which you have to qualify for. Two quick rules, and we're not going to get too much into the details, but basically, you or your spouse, whoever's qualifying for it for your family, needs to not have a full time day job, and they need to dedicate about 500 to 750 hours of active participation within your real estate portfolio. Some people think that being a real estate agent, buying and selling other people's properties counts, doesn't count. This is where it gets very personal. And again, that's why we tell people to utilize your free onboarding call, which takes you about 15, 20 minutes to discuss, does this stuff make sense to you? How does it look in terms of the IRS and the optics of this? Because we don't want people to evade taxes or do any tax fraud, but we want people to aggressively position themselves in terms of their taxes to get the biggest bang for the buck, because we feel like a lot of you guys out there are the ones working the hardest out there, ultimately paying the most taxes. Something I've learned on my journey is that the wealthy don't pay too much taxes, and they do it legally because they're investing in the right things, such as apartments, real estate, things that give them passive losses to play these types of techniques on their taxes. And it's unfortunately the working middle class that have a lot of W-2 1099 income that are constantly getting killed with this type of stuff and paying the most taxes. I know it's sure not the poor people paying the taxes, and it's not the wealthy people, and it's the people in the shrinking middle class. Perhaps you out there, and that's people we'd like to help out, and that's primarily the people within our ecosystem. Now, if you're selling off a rental property or selling off your primary residence and you're exceeding that $500,000 home sale exemption, you got to start to think about, when do you time it? When I sold off a lot of my rentals in 2017, I had a $200,000 capital gain that year, which most people freak out about. But if you're within our kind of network and our knowledge base, you understand that, all right, how much passive activity losses do I have? How much suspended passive losses do I have? Or should I say? And you can find this on your 8582 form. This is a form that go look up your PDF tax form, go Control F or Apple F, whatever it is, to find the 8582 form. And on there, you'll find how much suspended passive losses you have to be able to offset these types of capital gains and depreciation recaptures. Now, if you don't have it, I guess I'm not surprised, because a lot of times the CPAs don't want to give it to you guys, because that's a way for them to know when you're shopping around for a better CPA. Part of the activity is going to your 8582 form and see much suspended passive losses. And going back to my example in 2017, I had a $200,000 capital gain that I needed to knock out. If not, my AGI would have jumped up maybe to $400,000, $500,000 that year. And I would have been in this higher tax bracket, which I don't want to be in. But I had been investing in private placements and syndications prior years. And I believe I had maybe $300,000 or $500,000 of suspended passive losses. All I did was I brought over $200,000 of these suspended passive losses, and I knocked out my $200,000 capital gain, and it just neutralized that. And the cool thing is I took that money and I put it into more deals. And in that year and the following year, I ended up with even more suspended passive losses. And this is a concept that it's called different things, but a lot of people call it within our ecosystem as the golden hamster wheel. You're constantly investing and you're compiling more and more of these suspended passive losses, and it's more diversified, allowing you to knock out these, say this deal cashes out and that deal cashes out. You're able to neutralize these smaller tax spikes. And this is getting off of the whole 1031 mindset, which to me is an obsolete technique, where you've got all your money pooled in a handful of assets. You know me, I always tell people, as a general rule, you don't want more than 5 to 10% of your net worth into any one asset. But this rule is completely violated by most old school mom and pop investors who may own like a 20 unit or 40 unit on their own, or a big piece of real estate, maybe worth several $1,000,000. And that is a huge chunk of their net worth. We don't want that to happen, because that's just not good diversification. And secondly, as we talk to taxes, if you were ever able to sell that property for a good price, you have to mitigate that big tax hit using these types of techniques. What we would rather prefer is break up our portfolio into many small pieces. Let's just call it nickels here and there, 5% of your net worth here, there. And that way you're able to mitigate the tax gains when they do happen, because you have all this suspended passive losses built up. I'll give you a vision into the future. We call this passive loss nirvana, or tax pal nirvana. Once investors get around $500,000, $1 million of suspended passive losses, that's the point where you get to a point and you start to scratch your head and you're like, man, am I ever going to be paying taxes? At some point, you may stop investing. I don't know why you would, right? Unless you are truly to your end game, $5, $10 million net worth plus, and you stop investing and you start putting your money into more traditional investments, such as the stock market, mutual funds. And yes, I'm saying you may go back into that stuff without the tax benefits, but that's at your choosing, right? You may not stay in alternative investments for forever. But if you're listening to this video and your net worth is under $5 to $10 million, you need to be in alternative investments because you're going to get better returns. But mainly what the stuff we're talking about here is the tax mitigation, which allows you to grow your net worth without the government kind of reaching into your pocket every time you make a good investment. And this kind of goes into the whole, should I use an IRA, qualified retirement plan, solo 401k? These are retirement vehicles. They grow tax free. The problem is when you invest through one of these vehicles, you don't get the passive losses from the investment, or you get it, but it can't come over to your personal side for you to play these different techniques that we're talking about today. So you lose this huge advantage. Now, for certain people with super high incomes, maybe making over 400, 500,000 plus, a retirement plan, which, there's a bunch of retirement plans, solo 401k, self-directed IRAs, self-directed Roths. All these are what I call qualified retirement plans, or what we'll call QRP money. It may make sense. Again, that's why we tell you guys, get to know the folks in our ecosystem, book that free onboarding call, and we talk to these kind of personal finance issues. But from a high level, most people, retirement plans doesn't make sense. I tell people, fill up their today cash flow bucket outside retirement plans first. At least to your passive cash flow is around 10, 15, maybe even $50,000 a month. If that ain't you, I don't know why you're filling up a retirement plan just yet. The last kind of point, some people let the tax tail wag the dog. They spend money on things that they don't need in their business or their investing activities to save 20, 30 cents on the dollar. It's stupid, if you ask me. Big mortgage, but you'll be able to write it off. Why would you want to pay $100 to save $15, $25? That's dumb, right? It's an invalid argument. But sometimes it doesn't make sense to let the tax tail wag the dog. And here's a great example. You have a household making $600,000 a year. Their AGI, let's just call it $600,000 to call it even. And they're getting killed on their taxes, anywhere from like usually around $360,000 AGI. You're in that higher tax bracket and you're getting killed. What we kind of work with people is we look at where they are in the tax brackets, and it makes sense for, at the very least, to get under that $360,000 tax bracket level. And some would argue within our ecosystem, and I'm getting on board this train of thought, is getting below $200,000 AGI. So for a family, they need to cut their AGI $400,000. Some people even think, yeah, just drop it all the way down to zero. And this is possible, especially when most of your income is passive income, not that ordinary income stuff, which you don't have too many options unless you're doing rep status there. So getting back to it, like, how are we going to drop these guys down from 600 down to $200,000 AGI? This is where all these suspended passive losses, bonus depreciation come into play. It gives people the option, these mechanisms to lower their AGI with maybe they're doing real estate professional status. Now, it's always a trade-off, and people need to think about, is it make sense for them to hold on to these suspended passive losses in the future when these deals and investments cash out and have these bigger gains? I would argue more times than not, it's better to take that tax benefit today, because if you pay less taxes, now you can go and invest it in the future or even this year. And you're typically going to come out better. This is all the premise of time value of money. Another thing people will do is they will do a cost segregation on some of their personally owned real estate properties. We have a great resource page for people to do the do-it-yourself option. I am a little bit on the fence on the validity of this type of cost seg. It costs like $500, but hey, see if it's for you. I would argue if you're owning your own rental properties, a little hint, especially when you come into our ecosystem, you're going to start to realize sophisticated accredited investors do not own rental properties. Once your net worth goes over $1 million net worth, it makes no sense to own rental properties when you're the managing member. You've got to put in the headache. You've got the debt in your own personal name. You've got the personal liability. and you're not doing value add and you're not a professional real estate operator, but you're maybe a business owner or a high pay profession in some other facet. At some point, once you start investing in real estate syndications, this all is going to click for you, especially you come out to our events and meet some other people who've taken this path themselves. Therefore, you're not going to own your little portfolio of rental properties long term. And therefore, if you did a cost seg, you spending $500, maybe if you did the real one, the $5,000 cost seg, it's a waste of money because you're going to sell that asset and recapture all those passive losses that you got from that cost seg anyway. So something to think about. This is why even on our larger deals, we always have some discretion if we even are doing a cost segregation study. Sometimes we may get into a deal and things go really well, or the neighborhood location just isn't that great long term, 10 years plus. And we may choose to, all right, we're going to sell this thing early, year 3, and then may not make sense for us to do a cost seg at that point, right? Again, the key word here is discretion. I would say most cases we do optimize the passive losses, get that in our pocket and in our investors' pockets so you guys can maximize what you guys do with those passive activity losses. But the thing about suspended passive losses or these depreciation you get from these deals, you're going to have to recapture it at some point. If you can utilize these passive losses today, get a benefit for today, and then deal with it later on, or mix it in with other passive losses from your other parts of your investments, then what you'll find over time is that you've got this redundancy built in and you're running with a certain amount of suspended passive losses to mitigate any type of real estate sale and hopefully gain on your side too. But we talked a lot about stuff in this video and in effect, I don't want to go too much further, but hopefully this has created some more questions. If you got any questions, please put it in the comment box below. And if you haven't joined our group, get access to the opportunities that we're investing in and also sign up for that free onboarding call with myself to look into your personal situation. It's always a pleasure of mine. To me, it's like solving puzzles and it helps you guys and it gives me a lot of fulfillment doing what I do on this channel. And we'll see you guys on the next video. Bye. Going through this whole transition myself, it was really hard to do it without meeting other purely passive accredited investors out there. So that's why we've created the network, which you guys can join.